Hello, friends, and welcome to Derivatives. My name is Dr. BJ Tolia, and we are going to start out with the basics of different derivative instruments and their uses first. So, the focus for the exam is understand the different types of derivatives, and there are some that are called as forward commitments, which are futures, forwards, and swaps, and the other ones are contingent considerations, and there are options and credit derivatives. Now, be able to compare over the counter or OTC derivatives versus those that are exchange traded. And we'll talk about pros and cons of derivatives, meaning what are the risks involved and what are the benefits of using derivatives. And then finally, what are the issues, what are the uses of derivative products for issuers, companies, or investors. All right. So derivative is simply a security that derives its value. So the label derivative simply is based on the fact that it derives its value from an underlying. Underlying can be a variety of things. You can have different securities such as equities or bonds or equity indices, as well as rates, interest rates. And then it can also derive its value based on commodities as well as credit and credit indices. So the underlying can be a variety of different types, and obviously the derivative that derives its value from those types differs based on the fluctuation in the value of the underlying. Now, forward commitment, again, the label here is commitment. Okay, and both parties to that contract are committed to executing the contract. Contingent claims only come into play if certain contingency or condition is satisfied. So forwards, futures, and swaps are commitments, are forward commitments, whereby we enter into the contract today, but the obligation to complete the contract occurs at some future point in time. Options and credit derivatives are contingent. Why? Because the one party's obligation depends on occurrence of an event, on a condition. So it depends on an event. In the case of credit derivatives, where there is a credit event occurring, so typically that event is called as a default. When default occurs, that's when the satisfaction of that underlying instrument, the satisfaction of the derivative comes into play. In the case of an option, the holder of the option, the long party, the buyer, so the long is the same as buyer. So the long party or the buyer has a right to exercise the option, and that right is going to be exercised only if it is beneficial to the buyer. When you have a right but no obligation, you're always going to exercise your option only when it is beneficial to you. In the case of a call option, it is in the money when the stock price exceeds the exercise price. For a put option, it occurs when the stock price is less than the exercise price. We'll talk a lot more about call options and put options in a little bit. All right. So let's talk about derivative contracts. They can be exchange traded or over the counter. So exchange traded contracts are standardized. They're traded on an exchange and they are standardized. So it basically allows the exchange to list that contract. And because it is standardized, it can trade under a standardized contract. So under a uniform contract. Now, in case of exchange traded derivatives, there is a central clearing, meaning the exchange takes the opposite side of all trades. The exchange mandates deposit of a collateral, and that ensures that the parties that are entering into the contract conform to the contract, adhere to the contract. And these contracts are marked to market, which ensures again that the parties are not deviating too far from and the exchange is able to manage the risk of the counterparty not conforming to the contract, not adhering to the contract. So the clearinghouse basically takes opposite side of every trade. We'll talk about novation. That is a label used when the clearinghouse takes opposite side of every trade. So typically there is a contract involves a buyer and a seller. Well, that contract is broken up, and the buyer will then trade with the central clearing, and seller will similarly enter into a separate contract. So a single contract is broken up into two separate contracts, and so the clearinghouse becomes the risk taker to ensure that both the buyer and the seller conform to the terms of the contract. It ensures that the parties to the contract are not concerned about counterparty credit risk. You're not concerned about your other party reneging on the contract. It provides more transparency. Why? Because all the trades are reported. So it is part of the information history. It is more liquid. Exchange traded contracts are very liquid. So you can easily take an offsetting trade if you want to. And typically exchange traded contracts have lower costs. Now, OTC or over-the-counter contracts are basically custom contracts, just two parties agreeing to a contract. So they are very customizable. They are less liquid because if you want to, for example, you take a long position on a trade and you want to back out of that trade at some future point in time, it is difficult to find a party that takes your position, and then the other counterparty has to agree to substitute your position with somebody else. They need to check the credit quality of the substitute party as well. So because these transactions don't occur on an exchange, there is less reporting, there is less transparency, and the trading costs are higher. There is the information seeking costs are higher to find the appropriate counterparty. Now, many OTC markets are required to have a central clearing party. Why? Because it reduces the systemic risk in the market. You have all these over-the-counter contracts which are not reported, and the market-wide risks that entail may be too high in the event of a major fluctuation in the market price of the underlying, and could cause markets to melt down. So to manage the overall integrity of capital markets in a country, governments are requiring many OTC markets to move to CCP or have a central clearing party that mandates deposits of collateral and so forth. It reduces counterparty risk. Now, let's look at a quick example from the Institute curriculum books. Which of the following is a significant difference between exchange-traded derivative and over-the-counter? Choice A says ETDs create counterparty risk, which is not true. In fact, ETDs reduce or eliminate counterparty credit risk. So choice A is incorrect. Choice B says exchange-traded contracts or exchange-traded derivatives are standardized contract. Yes, they are standardized contract, while OTC derivatives are customized. So B is our most likely answer. Let's look at the last choice before we finalize. Choice C says ETDs have higher transaction costs. Actually, they have lower transaction costs as compared to OTC derivatives. So once again, we can now be comfortable choosing B as the correct answer. Another example, if a corporate issuer or a company enters into a centrally cleared OTC derivative contract, which of the following risks is likely of most concern to the issuer as well as to other participants in this market? So you are not concerned with counterparty credit risk because you are using centrally cleared. So you have a CCP taking the other side, managing the counterparty credit risk. Also, interest rate risk can be managed using a variety of derivative contracts. We'll see that when we talk about different types of derivatives. However, the concern remains is that of a systemic risk, meaning the CCP is unable to manage the risks it is taking with respect to diverse parties in that OTC platform. So systemic risk is the one that still remains even when it is centrally cleared, and that risk need to be managed by the CCP.